Hello friends, welcome to Trading Options. My name is Sachin Dharamkar, and in today's video we are going to understand the new rules brought by SEBI. Who is SEBI? SEBI is a regulatory body established by Government of India, and it regulates the security market in India. It protects the interest of investors, it regulates the functioning of capital markets in India, and it has the power to regulate and perform functions such as to check the financial statements of the companies, to check any price manipulations, to ban any insider trading, to protect unfair and fraudulent trade practices, to promote fair code of conduct in security market. Recently, SEBI has brought some new changes to the system. It has come up with new rules, of course, to safeguard the interest of investors. There are few advantages and disadvantages to it. In this video, we are going to see how the new rules are going to affect our intraday trading. While there are so many curriculars SEBI has shared recently, I'm only going to list the points which are relevant to intraday margins and investments. So let's see what are the recent changes with respect to intraday margins. So here are the topics that we are going to discuss in today's video. Stock delivery, the current system and the new system, dividends, how we are going to get the dividends in the future, current system and the new system, intraday margin, the most important topic for us, and phases of implementation as to how the new system is going to get implemented. Before we move forward, this is my first educational video. I request you to subscribe to my channel, hit the like button so that I can come up with many more educational videos which will help you in trading. Please watch this video till the end because there are few important source links I would like to provide by which you will be able to get first-hand information on any new curriculars from SEBI. So let's talk about our first point, stock delivery, the current system and the new system. I'll try to explain this in a simple language so that all of us can understand. As per the current system, all the shares that we purchase will be stored in a common pool, which is a broker's account. So all the shares, though it will show up in our Demat account, but will be there in a common account, which is broker's account. And that is why broker has an option to provide leverage to others. As per the new rules, all the shares purchased by the investors should be saved in their respective accounts. That means there won't be any common pool account of the broker. I think this is a great initiative of SEBI to safeguard our investments. Now let's talk about our next point, dividends. When we purchase shares, we get dividends, right? How are we going to get the dividends? Let's understand this. We learnt in our previous point that the shares are in a common pool, which is broker's account. Though the shares will appear in our individual account, but behind the scene, they are in a common account, which is broker's account. In case of dividends, brokers receive the dividends first and then they transfer the dividends to us. But as per the new rules, we are going to get the dividends. The investors are going to get the dividends because the shares will be lying in the individual investor's account, which is again a good initiative by SEBI. Here comes the most important point for us, intraday margin. What is intraday margin? Intraday margin is the leverage provided by a broker in order to trade on a day trading basis. Let's understand how it works. Intraday margin and the leverage system. In India, the intraday margin varies from broker to broker. Some provide 5x margin, some provide 10x margin, and there are few who provide more than 40x margin, which is quite huge. With a limited capital, you can trade with a huge quantity. Let's understand what is this margin. Margin means the leverage you get for trading on an intraday basis. In fact, there are few brokers who also provided margin on delivery as well. Now let's understand, if you are getting a 5x margin,
With a capital of 1000 rupees, you can buy or sell shares worth 5000 rupees. And in the same way, if you are getting a 40x margin, then with a capital of 1000 rupees, you can buy or sell shares worth 40,000 rupees. That is quite huge. Why do different brokers have different margin limits? Well, it could be their selling points. Some might say that with a lesser margin, they are giving a good platform to trade. Some might say they are giving a good platform to trade and also a bigger margin, so that with a lesser amount or with a less capital, a trader can trade in huge quantity. Well, taking leverage margin is a good thing as long as you are making profits. But if you are making losses, then the losses could be quite huge. Considering the interest of an investor, SEBI has brought a new rule on intraday margin. Let us understand what is this new rule says. As per SEBI want the brokers to collect VAR and ELR margin from its clients. That means from traders and investors like us. So let me take you to the NSE website where we can find the VAR details. So here we are on NSE website and we are looking at the details of Reliance stock. To get the information of value at risk, we need to click over here. The VAR margin for this stock is 17.61% and the extreme loss rate is 3.5% and the total applicable margin rate is 21.11%. That means if we wish to buy shares worth 1 lakh rupees, we need to have 21,000 rupees in our account. And let's look at a different stock. We'll look at Dr. Reddy and find out what is the VAR and applicable margin rate for Dr. Reddy. Again, to find out that information, we need to click over here. And the applicable margin rate is 16.55 in case of Dr. Reddy. That means if we wish to buy shares worth 1 lakh rupees, we need to have 16,500 in our account. This is the intraday limit we are going to get once the rules get implemented. As of today, the brokers are giving huge margins to us. We are getting 10x margin, 20x margin, 30x margin, 40x margin. There are some brokers who provide more than 40x margin. To control that, SEBI wants all the brokers to collect at least this margin, the applicable margin rate from the clients. So this is the maximum limit we are going to get once the intraday rule gets implemented. When are these new rules going to get implemented? Well, SEBI has given sufficient time to the brokers to implement these rules and they will get implemented in 4 phases. Let me take you to the SEBI's circular to give you more information about it. So this is the SEBI's circular and it was posted on July 20th. And it says framework to enable verification of upfront collection of margins from clients in cash and derivative segments. I'll scroll down to show you the phases. In the first stage, the broker would collect 25% of margin. In the second phase, 50% margin. The third stage, 75%. And in the final phase, the broker would collect 100% peak margin. By August 2021, all the phases of implementation will be done unless there are any amendments. You can read this circular to get complete details. I will share the link of this circular in the description box. We can read all the circulars by SEBI and get a first-hand information by visiting their website. Let me show you how their website looks like. This is SEBI's website and you will find all the circulars over here on this tab. Not all the circulars are related to us,
So please read the ones which are related to you. The most recent ones are over here. I'll post link of this website in the description box. That's all I have in this video. I hope I was able to clarify the new rules. Thank you so much for watching.